If you're running a business and clearing $200,000 or more, you should probably be paying a lot less in taxes than you currently are. Today, I'm going to walk you through 5 specific strategies that could change that many CPAs never bring up, or if they do, they don't go into enough detail to make sure you do it right. That's not because they're secret, it's because most CPAs just aren't paid to think proactively about how to save you money in the future. To save you money in the future. Hello, I'm Matthew Cersley, the owner and chief advisor at Agorist Tax Advice. Now, I'm not going to go super deep into each one of these 5 strategies today. Frankly, each one probably deserves its own video, and I've done videos on a few of them in the past. But you need to know these exist, and you need to be asking why no one's talked about them with you if no one has. First thing to do as a business is make sure your entity is structured properly. Most business owners set up their entity, their LLC, or their corporation once, and they never revisit it. Uh, the vast majority of companies do best as an S corp, but not all. There are some people who will save money as a sole proprietor, a partnership, or even as a C corporation. So just because the way you were set up made sense 5 years ago does not mean it's the right way to do it now. Additionally, it's not just picking how you're taxed. Each way of being taxed has its own rules you need to follow, documentation you need to do, etc. I've seen many people be designated as an S corp and never set up their payroll. That's a big problem. Um, but this is something that should be done on a regular basis because what worked when you made $150,000 is not going to be the right thing maybe now that you're making two, three, four, $500,000. Your entity isn't just a legal formality, it's a huge tax lever. And unfortunately, most business owners just set it and forget it. Number two, many business owners know about SEP IRAs or solo 401ks, although those are excellent plans as well. But as a business owner, you should also look into whether a defined benefit or a cash balance plan makes sense for you. Uh, these are more for people who are making, say, four, five, $600,000 a year. But for a high earning business owner, you can put 100 or even $200,000 a year into these for retirement and avoid the taxes on it. So if the only thing that you've heard about are IRAs or 401ks and not one of these plans, you maybe need to be asking about these and if they're the better fit for you. Number three, hiring family members. Now, hiring spouses usually doesn't make sense unless you're trying to put even more money into retirement savings. Hiring kids, however, can be great, especially those under 18 if you do it right. I have clients who have had 3 or 4 kids on the payroll, writing off 30, 40, even $50,000 a year and saving money on those taxes. This isn't even a gray area. This is 100% in the tax code. It's allowed. You should be looking at doing it. Now, it works for other family members as well. If you're currently helping support your parents, your siblings, your niece, your nephew, if you can hire them in your business legitimately, you're probably going to be able to give them more money at less cost to yourself because you're probably in a very high tax bracket. They're probably in a very low tax bracket. And so maybe they'll be paying 22% tax on this where you would be paying 37% tax. That's a 15% savings. It adds up. The next thing you should do as a business owner is look at real estate. Now, real estate is something anybody can invest in, but business owners have a few more options. One of the nice things about being a business owner is if you own the building that you're operating in, the ownership of that building will usually be considered uh, active instead of passive. That allows for cost segregation and immediate large write-offs when you buy that building. Now, maybe it doesn't make sense to buy a building where you are. Maybe you can't afford it. That's fine. It's something that you should look at if and when you're big enough. Now, you could also just invest in real estate to help offset income like anybody else. And this is something that I find many business owners have the money to do. They maybe don't have the time to do it. They maybe don't know about it. It can be a great investment. It can be a great tax savings tool. It's something that you should be looking into if you have a business and if you're making a lot of money. Uh, Final thing is accountable plans. Now, some CPAs do talk about this at least peripherally. Oh yeah, you can write off your cell phone, and some of your meals. But the accountable plan is the formal plan that lets you reimburse yourself for business expenses tax-free. This includes things like home office use, vehicle use, travel. These are expenses you're incurring personally that could be run through the business, and now you're saving 20, 30, depending on the state you're in, 40 or 45% by writing these off as a business expense and paying with before tax dollars instead of after tax dollars. Many small business owners aren't doing this, and if they are, they're not doing it right. You do need to do this right. You do need some documentation, or the IRS can disallow these expenses, and now you have a big tax bill, maybe coming years later with penalties and interest. So done right, an accountable plan is completely legitimate and can be worth thousands of dollars or even tens of thousands of dollars in savings per year. Done wrong or not done at all, you're leaving money on the table or causing a problem for future you. So if you haven't heard from your CPA or your financial people about what entity should you be in, about defined benefit plans, about family employment, about real estate, or about accountable plans, well, you got a tax preparer, not a tax planner. None of these are loopholes. None of these are even aggressive. They are all in the tax code, 100% black and white and allowed. So the only question is, are you using them? And if not, do you know why you're not? Is it because they don't apply to you? Or just nobody told you about it, and so you can't take advantage of it? Now, if any of these five sounded like something you might like to apply to your business and you want to know for sure, that's exactly what we dig into when I do my tax savings assessment. You can schedule that with me at the link below. Please like and subscribe if you want to see more videos like this in the future, and have a great day.